And our next guest believes the spillover from subprime has been contained, so the glass half full continues. And he does believe the Fed will still cut rates. David Doll is president and CEO of Kanaly Trust Company. All right, David, thanks very much for joining us. So let's just get this put together. You think subprime is contained, but you still think the Fed will cut. Well, why?
Well, Aaron, good to see you again. The bookends the Fed has been dealing with for the past several months, between employment data on one hand and then inflation on the other, seem to be setting up with the employment data coming out this week, where the Fed is going to be looking at numbers that may be a little bit weaker and put them in the position to cut. Our view is that the Federal Reserve has done a great balancing job here. The professor and Bernanke following some of the academic approach with words and some actions to the market. We see a Fed that is well positioned to support the markets, provide liquidity, and in response to the 90-day T-bill, which has very much been underneath the Fed funds rate, we see the Fed moving in that direction.
Interesting, though, David, if you think subprime is contained, and you look at a lot of these big investment banking CEOs now who are saying we're moving through this, it's more of a credit issue rather than a liquidity issue. You're seeing deals getting done. Consumer confidence remains strong. Consumer spending and incomes remain strong. You put all that together, even if you take a little bit of a hit to the economy from the havoc of the past month, this economy is still growing 2% plus. It's hard in that sense to argue for a rate cut, isn't it?
Well, arguing for a rate cut, I don't know if we'd be in the position to argue for it. We think the Fed's a follower in this equation. The T-bill rate is dramatically below where Fed funds are, and if they don't do it at the September 18th meeting, unless we see some economic data points that come together in some strong strength indicators, something that we haven't seen here recently. Consumer confidence, that's a pretty fickle number month to month. We've seen some slippage in the employment data. The big thing is going to be earnings coming up in the next 30 days. M&A isn't there to support earnings the way we've had for the last 3 or 4 quarters. The analyst estimates are somewhere around 4 or 5% for the third quarter. Really, are we going to see share repurchases from companies utilizing excess cash flow?
And David, you actually have a calendar on the liquidity situation, which I think is interesting. We talked so much on August 15th about how that was, quote unquote,
Indeed.
Let your hedge fund know you want your money back day. And then they had 45 days to give it back. So you're looking at, what, beginning of October as we're going to get a big rush of liquidity?
Yeah, that's a liquidity issue. With the 45-day window ahead of September 30th and folks coming to the redemption window for their hedge funds, it's no wonder we saw so much activity there in mid-August. The VIX soared above 30. We've seen it settle down in the low 20s now. And the calendar playing out, we're going to have some volatility for the month of September as the trading action for hedge funds to get ready to meet those cash calls is completed. The real question will be where the liquidity goes in the first part of October. In our view, it's going to find a home in large cap stocks, especially those that have the ability to focus on foreign sales, exportation.
All right. Well, David, thank you very much, as always.
Thank you, Aaron.
David Doll from Kanaly Trust.